This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky. Stocks often get a reputation for being a risky investment. As we've seen from 2022, stocks can quickly and easily lose 25, 30, even 40% of their value in just a matter of a couple months. However, I think this risk gets a bit overblown for a lot of people and prevents them from investing in stocks at all or investing as much in stocks as they should given their particular goals. The biggest issue is that most people only look at small periods of time when assessing the risk of a particular investment. Most commonly, people talk about the 1-year total returns, or to define risk, the 1-year standard deviation. This is a perfectly reasonable way to measure risk if your time horizon is 1 year. However, for most of us and most of your cash flow needs are not for the next 1 year. Most of you watching this video, even if you're retired, most of your cash flow needs occur in years 2, 3, 4, 5, 10, 20, 30, and beyond. So to measure a particular investment by its risk over a 1-year time period really doesn't make any sense at all. So in this video, we're going to talk about the actual risk of stocks, not just over a 1-year time period, but over a multiple year time period. We're going to compare that to the risk-free treasury bonds. And at the end of the video, I think you'll see pretty clearly what I mean when I say that over long periods of time, stocks actually aren't that risky. To make these calculations, I used the data from Aswath Damodaran, and what I did was simply calculate the total return over different time periods. So you can see here the S&P 500 total returns, including dividends, starting in 1928 by each of these years. There's also the US Treasury bond in these columns here. Again, each one of these representing a 1-year total return. So we can see that the 1-year risk of stocks is pretty significant. It's frequently either up 44% as it was in 1928 or down 44% as it was in 1931. Meanwhile, the T-bonds, or 10-year treasury bonds, are a lot less risky over any given time period. The biggest loss we see on the screen right now is in 1931 when they lost 2.5%. So over a 1-year time period, clearly treasury bonds are far less risky. However, what I did was calculate the returns over different time periods. So for example, a 2-year time period would be the total returns from 1928 through 1929. A 3-year time horizon would be 1928 to 1930, and so on. And I calculated each one of these rolling returns for up to 20 years. And then I calculated what was the worst possible return for each one of these assets over different time periods. And here were the results. So on the left side here, we're going to have the total negative or positive return. So we've got returns ranging from negative 60% all the way up to positive 60%. And then on this line, we're going to have time. So each of these will represent 1 year all the way out to 20. And we are looking at, just to be clear, the maximum loss over each one of these time periods. And I think maximum loss really reflects the actual risk that you're taking. Standard deviation, 1, doesn't really mean much to anyone, and 2, it could honestly be a good thing. If you have a high standard deviation, and that means you're getting big returns, you actually want more quote-unquote risk. So it's honestly sort of a silly way to measure risk. I think this reflects it much better. So first, let's start with bonds, and I'm going to use a blue dot to reflect the bonds. The worst return over a 1-year period for T-bonds was negative 11%. After 2 years, it was 6.4. 3 years was negative 3.5. 4 years was negative 2. 5 years was also negative 2. And then after 6 years, there was never a time where you didn't make at least 1.4%. After 7 years, this increased to 5.5%, then 8% after 8 years, 8% again after 9, 8% again at 10, 13.2% after 11. And keep in mind, these are not annualized, these are total. 15% after 12, 16% after 13, 20% after 14, then 25%, 28%, 31%, 34%, 31%, and the worst rolling 20-year return was 37.4. So now let's change colors, maybe to this dark green, to reflect how stocks did. And we see after 1 year, yes, stocks are very risky. The worst 1-year return was negative 44%. And remember, these are just calendar years, so if you look at the top to bottom loss, it would be even worse than that. Clearly, over a 1-year period, stocks are very risky. How about after 2 years? They actually get more risky. The worst rolling 2-year return was negative 57.9. And it gets even worse. After 3 years, the worst 3-year return was negative 61.6%. And even worse still, after 4 years, the worst return was negative 65. So we're clearly going in the wrong direction here for the maximum loss. And keep in mind, much of this was during the Great Depression, but things did get better. After 5 years, the worst return was negative 49.3. After 6 years, the worst return was negative 47.8. The worst 7-year return was negative 25. And I'm slightly rounding, is actually negative 24.9. These are all kind of approximates, but after 8, we have negative 28.7. After 9 years, actually negative 35. So again, we're heading in the wrong direction. Negative 15% after 10 years, negative 18.6% after 11. And then here we go back down, negative 29 after 12 years, negative 35 after 14 years. But then we finally start to see some permanent improvement. After 14 years, the worst total return over that period was negative 22.4. After 15 years, the worst return was only negative 0.3. And finally, after 16 years, the worst return was 15.5, a positive number for the first time. And then after 17 years, the worst return was positive 56.7. So we jump way up here. Worst return over 18 years was positive 44. After 19 years, positive 51.2. And after 20 years, the worst return was 59.8%. So what does all this actually mean? What can we take away from this particular chart? Of course, the future may not be like the past, but at least if you can bank on historical data, stocks were actually less risky than treasury bonds starting at year number 17. So let's say you're investing $10,000 today, and you do not plan to need this money for at least 17 years. This chart suggests that the least risky place to put this money, at least between these two assets, would actually be in stocks, not in bonds. Because again, the worst return you had over that time period was better than the worst return you had for bonds, which is here. However, let's say you had $10,000 that you were investing for your daughter's wedding or something, and then that was in, say, 5 or 6 years. Well, clearly, based on this chart, if you needed to keep that money as safe as possible, the best place to do it, again, between bonds and stocks, would be, obviously, bonds. The worst return they did over 6 years was still positive, very slightly positive, but it was positive, whereas the worst 6-year returns for stocks was less than negative 45%. So what can we actually do with this framework? In the next video, I'm going to talk about how to use this concept of more time-based standard deviation to determine asset allocation. This video is just an introduction to that concept. So if you're interested, please subscribe to the channel so you don't miss that video. Thanks to all of you who are supporting the channel via YouTube or Patreon. I am producing a little bit of additional content, more technical in nature for supporters. This week, that video is the S&P 500 valuation video. If you haven't seen that, I'll put a link to that in the description below. And I look forward to seeing you in the next video. Have a great week, everyone.